Right now, in a nondescript building in London's financial district, vault managers are triple-checking inventory spreadsheets that refuse to balance. Across the Atlantic in Chicago, senior traders are placing emergency calls to counterparties they haven't spoken to in years. In Beijing, government bureaucrats are finalizing policy documents that will fundamentally alter how commodities flow across international borders. And scattered across the globe, billionaires who built their fortunes in technology and finance are suddenly obsessing over a metal most people haven't thought about since their grandparents' silverware collection. The catalyst? It's not Bitcoin hitting new highs. It's not another tech stock going parabolic. It's silver, and what's unfolding right now hasn't been seen in living memory. I've spent nearly a decade immersed in precious metals, quietly building positions, studying market mechanics, and waiting for the conditions that are materializing before our eyes. Just last week, I acquired a piece at a coin show for $67 per ounce. That identical piece now commands a significantly higher premium, and we're barely scratching the surface. The 100-ounce bars sitting in my collection, each one now valued north of $7,900. But let me be clear, this isn't about personal wins. This is about witnessing a fundamental repricing that's been artificially held down for generations. Let's rewind to the last trading session. Silver surged $7.70 in a single day, over 10% in mere hours. When was the last time you witnessed a major commodity explode like that? This isn't typical market behavior. This is what happens when decades of institutional price suppression collide head-on with unstoppable physical demand. Current U.S. spot prices sit at 79,034 wons per ounce. But here's where the story gets fascinating. In Shanghai, that same ounce trades at $85. There's a $5 premium just to secure physical delivery on Chinese soil. Why the disconnect? Because Chinese market participants understand something Western institutions are only beginning to grasp. The relationship between gold and silver has always been a critical indicator for precious metals investors. Right now, the gold-to-silver ratio has compressed to 57. For those new to this metric, it measures how many silver ounces you need to equal 1 gold ounce. When this number falls, silver is strengthening relative to gold. Historically, ratio compression like this signals silver has substantial upside remaining. Interestingly, as this dynamic plays out, gold often becomes more attractive by comparison, creating a fascinating interplay within precious metals markets. Before we go deeper, make sure you subscribe to this channel because what's happening in metals markets is accelerating by the hour. I'll be covering every critical development as it unfolds. Hit that subscribe button and activate notifications so you catch every update. Now, complete transparency. Everything shared in this video serves purely entertainment and educational purposes. I'm not a licensed financial advisor. I don't manage anyone's capital, and nothing here constitutes investment advice. I'm sharing observations, research findings, and personal experiences with precious metals. Always conduct your own thorough research and consult qualified professionals before making any financial decisions. My approach involves collecting physical metal as a long-term personal strategy, and I'm documenting that journey with you. The mainstream financial media is finally waking up. Forbes ran a headline yesterday discussing silver prices near $79, hitting record-breaking territory for the first time. When major financial publications start covering something the precious metals community has been analyzing for years, it means the narrative has become impossible to ignore. Everyday investors who never considered silver are suddenly asking questions. People are recognizing potential that's been hiding in plain sight. Market capitalization perspective reveals something stunning. Among publicly tracked assets, silver recently climbed into the number 3 position. But that ranking only includes certain asset classes. Expand the view to encompass everything: real estate, oil, national currencies, commodities, major corporations. And the landscape becomes more nuanced. Real estate dominates at the summit, followed by oil. The Chinese yuan appears next. Remarkably, gold currently holds a larger market cap than the US dollar. The euro follows, then copper, natural gas, and the Japanese yen. Tech giant Nvidia commands a massive valuation. And just below that, silver. Yesterday, silver's market cap overtook the British pound. If this trajectory continues, and silver moves past Nvidia, it breaks into the top 10 global assets by total value. Consider that for a moment. A physical metal you can hold in your palm, competing with entire national currencies and trillion-dollar technology conglomerates. This year's performance has been nothing short of extraordinary. Silver is up 174% year-to-date. Let that register. While equity investors celebrated 20% or 30% annual returns, silver has nearly tripled. We have just a few trading days remaining in the year. But if this parabolic momentum continues, we'll witness something genuinely historic. These are portfolio-altering, wealth-shifting gains. Here's a development that should alarm anyone tracking global trade dynamics. In just 5 days, on January 1st, China implements strict export restrictions on silver. These aren't minor regulatory adjustments. These are comprehensive controls requiring special government licenses for any silver departing the country. Why does this matter critically? Because China represents a major force in global silver markets. When they constrict the supply valve, the entire world feels the pressure. Supply is already critically constrained globally. Refineries operate at maximum capacity. Mints can't satisfy demand. And now, one of the world's largest silver producers is essentially declaring they're retaining their metal domestically. That Shanghai premium of $85 per ounce isn't random market noise. It's a clear signal that physical metal in that region commands higher prices because market participants there comprehend the supply reality. The London Bullion Market Association faces what numerous analysts characterize as an existential crisis. This organization essentially establishes benchmark pricing for precious metals in European markets. They operate vaults, facilitate trades, and maintain the infrastructure enabling silver to trade smoothly. But presently, that system is under extreme stress. Reports indicate every single request to extend silver lease agreements expiring within the next 2 weeks is being categorically rejected. The offered interest rate is irrelevant. The answer remains no. Why? Because the entities actually holding physical silver refuse to release it at any price. They see what's approaching. Whispers suggest London may be experiencing what could only be described as a vault run. When individuals and institutions simultaneously demand physical delivery, the system buckles. The Bullion Market Association might have no alternative but to reprice silver dramatically, potentially matching Shanghai's physical price of $82 to $85 per ounce, just to prevent complete systemic collapse. Imagine the implications when the benchmark price, the entire Western world relies upon suddenly jumps $5 to $10 within hours. That's the kind of event that sends seismic waves through global financial markets. In Chicago, the Commodities Exchange confronts its own crisis. They just established an all-time record with over 63 million ounces of silver scheduled for December delivery alone. That's an astronomical volume of physical metal. The problem? Serious doubts exist about whether they can actually deliver all of it. When exchanges can't meet delivery obligations, they typically settle in cash instead. But what does that reveal? It reveals that paper contracts and physical metal have become two fundamentally different things. The paper market says one thing. The physical market screams something else entirely. This divergence is dangerous, and it's precisely what occurs before a market completely breaks down. The banking sector is in scramble mode. Multiple banks that had been betting against silver, holding massive short positions, expecting prices to fall, now face catastrophic losses. These aren't small regional institutions. These are banks that had to tap the Federal Reserve's emergency repo facility for over $17 billion just last Friday alone. Consider that number. $17 billion in emergency liquidity needed because their bearish silver bets went disastrously wrong. Some institutions are carrying billions in unrealized losses. Without the Fed providing emergency funding, several might not survive. This raises a crucial question. Is silver about to trigger serious problems for the global banking system? The exchange's response has been predictable. They're raising margin requirements. This marks the second time in just over a week. Approximately 7 days ago, they implemented margin hikes, and it accomplished absolutely nothing to slow the rally. So now they're attempting again. What does raising margin mean? Essentially, they're making it more expensive for traders and businesses to hold futures contracts on silver. It requires more capital up front, which theoretically should reduce speculative buying and cool the market. These new requirements take effect Monday, December 29th. Many traders are bracing for a potential price slam when markets open, a coordinated effort to push prices down. But here's the thing. If silver shrugs off this margin increase, just like last week, we could see prices absolutely detonate. Margin on gold is increasing 10%. Silver faces a 13.6% increase, even steeper than last week's hike. Platinum is getting hammered with a massive 23% margin increase. The powers that be are deploying every tool available to slow this rally. The question is whether it will work this time. If you're finding value in this deep dive into what's really happening in silver markets, do me a favor and drop a comment below with your thoughts. Let me know what you think happens next. Your engagement helps this channel grow and shows me what content resonates with you most. There's always tension between different analytical schools of thought in markets. On one side, we have seasoned analysts who've witnessed these explosive moves before and remain skeptical. One veteran trader who's navigated 6 different decades of commodity markets posted a message recently. His point was straightforward. Every time there's been a supply-demand imbalance in commodity markets, people claim, "This time is different." According to him, it never is. He's observed booms and busts repeatedly, and he believes this silver rally will eventually correct just like all the others. His experience tells him to enjoy the ride, but don't expect it to last forever. That's the bear case, and it comes from someone with genuine market wisdom. But let's examine the bull perspective. Another prominent analyst compared this moment to historical silver rallies, specifically referencing the Hunt brothers situation from decades past. Back then, the Hunts were accumulating massive silver quantities purely for speculation. Everyone knew they had no intention of actually using the metal for industrial purposes. It was purely a financial play. Eventually, the market corrected sharply, but today's situation is fundamentally different. The silver being accumulated now is largely driven by industrial demand. The growth sectors of the modern economy, green energy, electric vehicles, solar panels, electronics, medical equipment, advanced manufacturing, all require silver. It's not optional, and everyone in the market understands that current silver supplies are insufficient to meet forecasted demand for years ahead. So perhaps, just perhaps, this time actually is different. The fundamentals supporting silver now aren't based on speculation. They're based on real-world consumption that's only accelerating. When you examine the 160-year chart for silver, you observe something remarkable. This metal has broken out of a pattern that held for over a century. Technical analysts dream about these kinds of breakouts. Some projections on these charts show arrows pointing toward potential prices as high as $400 per ounce. Now, I'm not declaring silver will definitely reach 400. That would be an extraordinary move. But the point is that once you break through these kinds of long-term resistance levels, the upside potential becomes extremely difficult to predict. Historical precedent suggests that when commodities break out of century-long ranges, the moves can be substantially larger than anyone initially expects. Even influential figures outside the precious metals world are taking notice. The wealthiest individual on the planet tweeted about silver yesterday. His message was clear. This is not good. Silver is needed in many industrial processes. He was responding to the 10-cent single-day spike. Consider his perspective. He's building electric vehicles that require substantial silver for electronics and electrical systems. He's manufacturing solar roof tiles that are silver-intensive. He's developing artificial intelligence data centers that need silver in their infrastructure. He's building rockets, satellites, and countless other technologies that all require this metal. When silver prices surge, his costs increase dramatically. From his viewpoint as a manufacturer, this price spike represents a problem. But here's what's interesting about his comment. Multiple responses pointed out that maybe he should have acquired a silver mine years ago. After all, mining companies are dramatically undervalued compared to the metal they produce. One commenter simply stated, "You can't print silver." That's the fundamental truth backing everything we're discussing. There's a powerful visual that illustrates the evolution of currency and value over time. It begins with physical silver coins that actually circulated as money. That was real, tangible currency with intrinsic value. Then the system shifted to paper currency, supposedly backed by silver. You could theoretically exchange that paper for actual metal. Then we moved to pure fiat currency, paper-backed by nothing except government decree and collective faith. Now we're at a point where many economists worry about the end game of fiat currency systems. Historically, all fiat currencies eventually suffer from inflation, devaluation, and sometimes complete collapse. We've witnessed it repeatedly throughout history. As governments print increasing amounts of money to solve short-term problems, long-term consequences become inevitable. That's why people return to tangible assets, things that can't be printed or created from thin air. Silver represents exactly that kind of security. Let me be honest about what I expect going forward. I don't possess a crystal ball. and I can't tell you with certainty whether silver rises or falls when markets open Monday. The margin requirement increases, definitely create downward pressure. Traders heavily leveraged might be forced to close positions. That selling could temporarily push prices lower. But simultaneously, there are powerful forces pushing silver higher. The physical supply crunch, China's export restrictions, industrial demand, banking sector stress, and the breakdown in London markets, these aren't minor issues that resolve over a weekend. These are structural problems requiring time to work through. Here's what I want newer investors to understand. If you're just hearing about silver for the first time because it's in the news, because you're seeing videos about it, because suddenly everyone's talking about it, that's fine. Welcome to the conversation. But understand that precious metals investing is not a get-rich-quick scheme. I've been accumulating metal for nearly 9 years. My approach has always been based on long-term wealth preservation and gradual accumulation. I don't worry about day-to-day price movements. I don't panic during corrections. I don't get overexcited during surges. My plan is measured in decades, not days. So whether silver rises or falls Monday, or even what happens next year, doesn't fundamentally change my strategy. Of course, I want to see price appreciation. Every asset holder does. But my time frame extends much longer than most traders consider. That said, I do have a personal price prediction, and I'm putting it on record. I believe we'll see $150 silver by 2026. That might sound aggressive to some, it might sound conservative to others who think silver will go much higher, much faster. But based on everything I'm observing, the supply constraints, industrial demand trends, monetary policy environment, and technical breakout patterns, I think 150 is a realistic target within the next 18 months. Of course, I could be completely wrong. Markets are unpredictable, and unexpected events can change everything overnight. But that's my current assessment, based on available information. The silver market right now stands at a critical juncture. We're witnessing real-time repricing of a commodity that's been suppressed for decades. The gap between paper prices and physical prices is widening. Major institutions that facilitate silver trading are under unprecedented stress. Governments are implementing trade restrictions. Industries are competing for limited supplies. And retail investors are finally starting to pay attention to a metal many had written off as boring or irrelevant. All these factors are colliding simultaneously, creating a perfect storm that could drive prices significantly higher. One thing that's become clear: traditional price suppression mechanisms are losing effectiveness. For years, whenever silver started rallying, we'd see coordinated actions to cap gains. Margin requirements would increase. Large sell orders would hit the market at strategic times. Media coverage would turn negative, and the rally would fizzle. But something feels different now. The underlying fundamentals are so strong that these tactics aren't working like they used to. The first margin increase accomplished nothing. The second one might also fail. What happens when the standard playbook stops working? That's when markets can move in ways that shock everyone. The situation in China deserves more attention. Their decision to implement export controls starting January 1st isn't happening in isolation. China has been systematically working to secure control over critical materials and commodities. They've done this with rare earth elements. They've done it with various industrial metals. Now they're doing it with silver. This is strategic resource management at the national level. They understand that whoever controls the supply of essential materials has leverage over industries depending on those materials. Silver isn't just a precious metal for investment. It's a critical industrial commodity absolutely necessary for modern technology. By restricting exports, China is essentially prioritizing domestic industrial needs over selling to foreign markets. This has enormous implications for global supply chains. The premium between Shanghai prices and Western prices should concern market watchers. A $5 per ounce spread might not sound dramatic in percentage terms, but it represents a fundamental disconnect. In efficient markets, prices for identical goods should converge through arbitrage. If silver is $5 cheaper in New York than Shanghai, traders should buy in New York and sell in Shanghai until prices equalize. But that's not happening. Why? Because you can't easily move physical silver from Western vaults to Chinese buyers right now. Physical constraints, logistics, regulations, and soon export restrictions all prevent arbitrage from working. When arbitrage breaks down, it means the market isn't functioning properly. And when markets don't function properly, volatility increases dramatically. The banking situation is perhaps the most underreported aspect of this entire story. When major financial institutions need to access $17 billion in emergency funding because of losses on silver positions, that's not a minor event. That's a systemic risk indicator. The Federal Reserve's repo facility exists specifically for these kinds of emergencies, when banks need immediate liquidity to cover obligations they can't meet with current assets. The fact that silver short positions have created this need tells you how large and how risky these bets had become. Banks weren't shorting small amounts. They were massively exposed, believing silver would remain contained within a certain price range. When that assumption proved wrong, losses accumulated faster than they could manage. What happens if silver continues higher and these banks face even larger losses? If multiple large institutions are simultaneously struggling with precious metals exposure, we could see broader financial instability. This isn't fear-mongering. Right now, there's clear evidence that some banks made very concentrated bets against silver that are now underwater by billions of dollars. The delivery situation in Chicago represents another stress point. 63 million ounces scheduled for delivery. To put that in perspective, that's roughly 1,060 tons of physical metal that needs to move from vaults to end buyers. The logistics alone are challenging, but the bigger issue is whether that much physical silver even exists in deliverable form in exchange vaults. If it doesn't, if the exchange can't meet delivery obligations, they'll settle in cash. And once that perception sets in, that paper contracts are just paper, the paper market loses credibility, which only accelerates the move to physical metal, which creates even more delivery pressure. It's a vicious cycle. The comparison to historical silver movements is instructive. Many skeptics point to the Hunt brothers episode as proof that silver rallies always end badly. But that was primarily a speculative bubble driven by two individuals using leverage to corner the market. What's happening now is fundamentally different. It's driven by structural supply deficits, industrial demand that's not disappearing, monetary policy that's devaluing currencies, and geopolitical tensions that make physical assets more attractive. These are lasting factors, not temporary speculation. The industrial demand for silver warrants closer examination. Electric vehicles use substantially more silver than traditional cars because of all the electronics, sensors, and electrical systems. Solar panels are silver-intensive. 5G infrastructure requires silver. Medical applications are expanding. As the world transitions to greener energy, more electric transportation, more connected devices, and more advanced manufacturing, silver consumption increases. This isn't theoretical demand that might materialize someday. This is happening now. Companies are manufacturing these products today, and they need silver to do it. Unlike investment demand, which can reverse if people decide to sell, industrial demand is relatively inelastic. Companies can't easily substitute other materials without redesigning entire production processes, which takes years and massive capital investment. Here's another critical point. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. This means silver supply is somewhat tied to the production cycles of other industrial metals. You can't just mine more silver quickly in response to price increases. It takes years to bring new mines online, and silver-specific mines are rare. Meanwhile, demand keeps growing. That's basic supply and demand economics, and it's playing out right now in real time. When a commodity breaks out of a multi-decade range, technical traders view that as a major signal. Think of it like water behind a dam. Pressure builds for years, decades even, but the dam holds. Then one day, the dam breaks, and all that pressure releases at once. Decades of suppressed prices, growing industrial demand, shrinking investment supply, and monetary debasement have all built up pressure. Now that pressure is being released, and predicting where it stops is very difficult. Some projections calling for $400 silver seem extreme on the surface. If silver went to $400, that would be roughly an 18x increase from current levels. During the 2011 spike, silver went from around $8 to $49, which was about a 6x move. An 18x move would certainly be historic, but it's not without precedent in commodities markets. Other industrial metals have seen similar explosive moves when supply-demand fundamentals reached critical points. The question is whether the fundamental drivers are strong enough to support that kind of valuation. My personal view is that $400 is unlikely in the near term, but I wouldn't rule it out over a longer time horizon if the supply situation becomes truly critical. When someone with massive influence expresses concern about silver prices, it amplifies awareness tremendously. While his concern was about rising input costs for his companies, the net effect was broadcasting to a massive audience that silver is important, scarce, and experiencing significant price movement. Sometimes the best marketing for an asset comes from unexpected sources. Precious metals, miners are historically undervalued relative to the metals they produce. When silver prices rise 174%, but mining stocks only rise 50% or 60%, that disconnect represents an opportunity for investors who understand the space. Mining companies have leverage to metal prices. Their profit margins expand dramatically when metal prices rise because their costs remain relatively fixed. If silver continues higher, well-managed mining companies could see explosive earnings growth. Looking ahead to Monday's open, we have several possible scenarios. Scenario 1. The margin increases work as intended. Speculative positions get liquidated and prices pull back sharply. This would be viewed as a healthy correction and might provide a better entry point for buyers who've been waiting. Scenario 2. The margin increases have minimal impact. Silver consolidates briefly, then continues higher. This would be incredibly bullish because it would demonstrate that the rally is driven by more than just speculation. It's driven by fundamental forces that can't be controlled by exchange rule changes. Scenario 3. Something breaks, either in London or Chicago, forcing a cash settlement crisis or a dramatic repricing, and silver gaps significantly higher. This is the scenario that keeps risk managers awake at night. Scenario 4. Geopolitical events or macroeconomic news overshadows the silver market entirely, creating volatility that swamps any impact from margin changes. Markets don't exist in a vacuum. External shocks can change everything quickly. For those considering getting involved in physical silver at these levels, understand both the opportunities and the risks. The opportunity: if industrial demand continues growing, if supply remains tight, if monetary policy stays loose, and if geopolitical tensions increase, silver could go substantially higher from here. Some analysts think we could see $100, $150, even $200 within the next couple of years. The risk: this could be closer to a top than a bottom. If industrial demand softens due to recession, if new supply sources come online faster than expected, or if alternative materials replace silver in key applications, prices could correct significantly from current levels. Nobody can predict the future with certainty. Long-term holders who've been accumulating silver for years are in a very different position than someone buying for the first time at $79. Those early accumulators have massive gains already realized. They can afford to hold through volatility because their cost basis is so much lower. New buyers at current prices don't have that cushion. Does that mean you shouldn't buy at current prices? Not necessarily. If you believe the fundamentals support much higher prices, if you're willing to hold for multiple years, regardless of short-term volatility, if you're sizing your position appropriately as part of a diversified portfolio, then current levels might represent a reasonable entry. But if you're hoping for quick gains and plan to sell at the first sign of trouble, you might want to wait for a pullback. There's no universally right answer. It depends entirely on your individual situation, risk tolerance, time horizon, and conviction level. One thing that gives me confidence in silver's long-term prospects is the monetary environment. Central banks around the world have expanded money supplies dramatically over the past decade and a half. Every time there's an economic crisis, the solution is more monetary stimulus, more currency creation, more debt. This isn't sustainable indefinitely. At some point, the accumulated effects of all this money printing manifest in currency devaluation and inflation. We've already seen significant inflation over the past few years. The official numbers understate the real lived experience of most people. When currency is being devalued, hard assets, like precious metals, tend to hold value better. It's not that silver becomes worth more in real terms, necessarily. It's that the currency it's priced in becomes worth less. This is a fundamental driver that supports all precious metals over long time horizons. What we're witnessing in silver markets right now is about more than just one commodity's price movement. It's about the tension between paper claims and physical assets, between financialized markets and real-world commodities, between unlimited digital currency and limited physical resources. These tensions exist across many markets, but they're especially pronounced in precious metals because of the history and the emotions involved. Silver has been money for thousands of years. It's deeply embedded in human consciousness as a store of value. When people lose confidence in abstractions, in paper promises, in digital balances, in government assurances, they return to tangibles. That's a tailwind for physical assets like silver that you can hold in your hand, that have intrinsic value and that can't be created by central banks with a computer keystroke. As we approach the end of this analysis, I want to emphasize the importance of doing your own research. Don't just take my word for it, or anyone else's word for that matter. Gather information from multiple sources. Understand different perspectives. Think critically about what makes sense for your particular situation. The silver market is complex, with legitimate bulls and bears who have well-reasoned arguments. Your job is to evaluate those arguments and decide what you believe. But whatever you decide, make sure it's an informed decision based on careful analysis, not emotional reaction to price movements or fear of missing out. We're at a potential inflection point where markets either validate this breakout and silver continues substantially higher, or we see a major correction that shakes out weak hands and tests everyone's conviction. Either outcome will teach us something important about market dynamics, supply and demand fundamentals, and the effectiveness of official intervention in commodity markets. I'll be here covering all of it, sharing updates, analyzing developments, and continuing to document this journey. Make sure you're subscribed so you don't miss what happens next. Drop a comment below with your silver price prediction. Where do you think this goes? Are we heading to $100, $150, $200, or beyond? Or do you think there's a major correction coming first? I want to hear your thoughts, and your engagement helps this content reach more people who need to see this information. The coming weeks will be absolutely critical. China's export restrictions take effect in just days. We'll see how markets react to the second margin increase in a week. We'll find out whether London can resolve its delivery crisis without repricing. We'll learn whether Chicago can actually deliver 63 million ounces or if cash settlements become the norm. And most importantly, we'll discover whether this rally has the fundamental strength to continue despite every effort to contain it, or whether this represents the blow-off top that skeptics have been predicting. One thing is certain: the silver market will never be the same after what's happening right now. Whether prices go up or down from here, the structural issues that have been exposed, the supply constraints, the paper-physical divergence, the banking sector exposure, the geopolitical implications, these aren't going away. The silver market has been asleep for decades. It's finally waking up. And when a market that's been dormant for that long finally moves, the results can be spectacular. Thank you for watching, and I'll see you in the next update.